Welcome to Talk Tickers. Today we're diving into CASY's General Stores. That's ticker CASY. They just dropped a huge earnings report, a beat of nearly 20%. So you'd think the stock would be soaring, right? Well, nope, it actually sold off. So what is going on here? Let's get into it.
Yeah, you heard that right. A 19% earnings beat, and the stock ends up falling over 1%. On paper, this quarter looks absolutely stellar. I mean, they beat expectations pretty much everywhere you look. But Wall Street basically just shrugged. So we've got to dig a little deeper to figure out what the market is really seeing.
Okay, so first up, let's talk about the big number, the one that should have been the star of the show, $5.77 for earnings per share. Wow. I mean, that's not just a little beat, that is a massive 19% jump from last year. That's some serious firepower to kick off their fiscal year.
And it wasn't just about profits either. The strength was right there on the top line too. They pulled in $4.57 billion in revenue. That's an 11.5% increase. You know, that tells you people are walking in and spending more money, which of course is what's feeding that incredible earnings growth we just saw.
So let's just put all this into perspective against what Wall Street was actually expecting. It was a total beatdown. I mean, they didn't just beat on earnings, they absolutely crushed the estimate by over 70 cents. Revenue, beat. And EBITDA, that key profitability metric, up a whopping 20%. So with a report card like this, you have to ask, where is all this power coming from?
All right, so when you peel back the layers, you see that CASY's is really firing on two cylinders. Let's break down those two growth engines. It's really a tale of two businesses under one roof. First, you've got what's happening inside the store. Think of it as this high-margin machine, just pumping out profits from things like their famous pizza. Then, you've got what's happening outside at the pump. And here, they're showing some really smart, disciplined execution, selling more gas and making good money doing it.
And this is where the real magic happens for CASY's. It's all about the margins. Just look at that prepared food and beverage slice of the pie. We're talking gross margins around 58, almost 60%. That is incredible. So here's the thing you got to understand. CASY's isn't really just a convenience store. It's basically a high-margin restaurant that happens to sell gas on the side.
And man, they are just killing it in this part of the business. Same-store sales were up over 4%, and the really important part? That's coming from more people actually walking through the door. They're buying whole pizzas, they're buying bakery items, and they're also grabbing those profitable add-ons like energy drinks, which just juices the margins even more.
Okay, now let's switch gears and look at the pump. This is where you can really see them dominating. Get this, the entire region they operate in saw fuel demand drop by 3%. But CASY's? They actually grew their gallons sold by almost 2%. That's a nearly 5-point difference. It's clear as day. They are stealing market share right out from under their competitors. All right, so we've got a fantastic story inside the store, and we've got them crushing it at the pump. Which brings us right back to that big question from the beginning. Why on earth did the stock drop? Well, the answer isn't in what the company did, it's in what they didn't do. You know, it really all boils down to one word, guidance. After putting up numbers like this, a monster quarter, the market was practically begging for management to raise their forecast for the rest of the year. And crickets. They didn't do it. And that's why you see quotes like this one calling the unchanged guide disappointing. The market wanted more, and it didn't get it. So yeah, instead of raising the bar, they just reiterated. They stuck with the same targets they'd already laid out. And to Wall Street, that sends a very specific signal. It suggests, hey, maybe that amazing first quarter was a bit of a fluke, not the new normal. Investors were looking for a big vote of confidence, but what they got felt more like caution.
Now, this isn't management being asleep at the wheel. This caution is actually part of their long-term playbook, what they call the scale and mix strategy. The idea is simple, but it's really powerful. They focus on two things: adding more stores, that's the scale, and selling more of that high-profit pizza and prepared food, that's the mix. So what they're telling us is, look, we're not going to get distracted by one great quarter. We're sticking to the plan that we know works for the long haul.
Okay, so let's put it all together. You've got this amazing quarter on one side and a very cautious management team on the other. So what's our call on the stock going forward?
All right, here's what you need to be watching over the next few quarters. We've got 4 big catalysts. Number 1, holiday promotions. How do they do in Q2 and Q3? Number 2, the CEFCO acquisition. We need to see them converting those stores and rolling out their kitchens. 3, fuel margins. Was this quarter a fluke, or can they keep it up? And number 4, the big one, do they finally raise guidance when they report again in December?
So here's our final call. We're rating CASY's as market perform. And look, the reasoning is pretty straightforward. The company is executing beautifully. I mean, they're doing almost everything right. But the market already knows that, and it's priced in. For the stock to really take the next leg up, management has to give investors a new reason to get excited. They need to signal that the future is even brighter than we think.
So I guess the big question for CASY's is this. In a market that's always hungry for the next big thing, is being a steady, disciplined, fantastic operator enough? We'll be watching that December earnings call very, very closely for an answer. And of course, just a quick reminder, this is for informational purposes, it is not financial advice.